Welcome to the Opening Bell Report.
You know, looking at the market right now, it is January 2026. It feels like we're stuck in a bit of a loop. For 2 years straight, if you asked anyone for an AI trade, they gave you the exact same answer.
You buy the chip makers.
You buy NVIDIA, you buy AMD, and honestly, it makes sense. They're the rock stars of the revolution.
It's the default answer. It's sort of the path of least resistance. And let's be fair, it has worked incredibly well for a lot of people.
It has. But I've been digging through the stack of research you sent over, specifically this new analysis report dated for tomorrow, January 21st, and it's painting a picture that makes me a little uneasy about that consensus.
Oh, yeah?
The analogy that jumped out at me: we are all staring at the roof of the house, admiring the shiny new solar panels, while the foundation is literally cracking under the weight.
That is a perfect way to frame it. The market often gets tunnel vision. We are obsessed with the visible layer of AI, the chatbots, the image generators, the processors.
The software.
The software interface. But we're completely ignoring the physical reality that allows that software to exist in the first place.
And that is the mission for today's deep dive. We are pivoting, we are looking away from the code and the silicon, and we're looking at the physics.
Right.
We have an analysis report here that is pounding the table aggressively on what they call the hidden AI play. And the title of this analysis essentially sums it up: Why I'm Buying Copper and Gold at W.
And to be clear, this isn't some obscure penny stock we found in the back of a newsletter. The report centers on a massive industrial giant, Freeport-McMoRan, ticker symbol FCX.
But here's the thing that hooked me. This isn't just a buy this stock recommendation. It's a thesis about a structural deficit in the global economy, a hidden asset, and a technical setup on the charts that looks like it's about to snap.
It's a convergence. I mean, usually in these deep dives, we find a great fundamental story or a great technical chart. This report argues we have both happening at the exact same moment.
So let's unpack this. Let's start with the macro thesis, or what the report calls the plumbing of AI.
The plumbing is the perfect metaphor. Because without plumbing, the house is, uninhabitable.
I think most listeners understand that computers use electricity. That's not news. But the scale of the numbers in this report, they're shocking.
They are staggering, and this is the key takeaway right at the top. The difference between a Google search and a ChatGPT query isn't just software, it's energy density.
Okay.
The report highlights that AI data centers use 3 to 10 times more power than traditional server farms.
3 to 10 times. That is a massive multiplier.
It is. We aren't talking about a marginal increase where you just plug in a few extra extension cords. We are talking about an exponential jump in load.
So if we are building data centers all over the world to support these large language models, the strain on the electrical grid isn't just high, it's unprecedented.
Exactly. And this brings us to the AI power thesis. You can't just wish for more electricity. You have to generate it, and crucially, you have to transmit it.
Right.
The report emphasizes that you cannot build the AI infrastructure the world wants without physically upgrading the electrical grid. And what is the grid made of?
Copper.
Copper. It is the non-negotiable metal. Physics dictates it. It's the most efficient conductor for the price. If you don't have the copper to move the electrons, those NVIDIA chips everyone loves, they're just expensive paperweights.
But here's where I want to push back a bit, because I think a rational listener might say, okay, we have a shortage, markets usually fix this, right?
Right.
Price goes up, people dig more holes, supply meets demand. Why is copper different? Why is the report calling this a structural deficit?
That is the key question. The difference is time. In software, if demand spikes, you spin up more servers on AWS. It takes minutes.
Right.
In mining, if you decide today to open a new copper mine, do you know how long it takes before you get the first pound of metal?
I'm guessing a few years.
Try 10 to 15 years.
Mm-hmm.
You have permitting, environmental studies, infrastructure, and then the actual digging. The report argues we are facing a supply cliff.
A supply cliff.
The demand from the AI build-out and the green energy transition is hitting now. But the new supply, it's a decade away.
So we have an immovable object meeting an unstoppable force.
Precisely. And that economic collision is why copper prices are sitting near highs around $4.68 per pound, according to the report.
Okay, so copper is expensive. Good for miners. But let's translate this for the investor. Why is this leverage so powerful?
It's all about operating leverage. Think of it this way. It costs Freeport-McMoRan a relatively fixed amount to run the mine fuel, labor, equipment. Let's say, just hypothetically, it costs them $2 to produce a pound of copper.
Okay, following you.
If copper is at $3, they make $1 profit. Simple enough. But if copper goes to $4.68, their costs stay roughly the same, but their profit jumps to $2.68.
So the price of the commodity went up 50%, but their profit went up over 160%.
You got it. That is why the report says FCX's free cash flow doesn't just grow, it explodes in this environment.
So High copper prices are bad for someone trying to wire a house, but fantastic if you're pulling the stuff out of the ground. But that leads to the obvious question. Why Freeport-McMoRan? Why FCX? Why not just buy a copper ETF or trade copper futures if you believe in the thesis?
That's where this specific report gets really interesting. It highlights FCX because it is one of the only major liquid U.S. stocks offering this specific exposure.
Okay.
If you're a large institution or a retail investor wanting to bet on the AI grid, FCX is the blue chip vehicle to do it. But there's a twist.
There's always a twist.
If you just buy the commodity ETF, you get the price of copper, period. If you buy FCX, you get what the report calls the double barrel value. And this is the part that I think catches a lot of people off guard.
You're talking about the hidden asset.
Exactly.
The Grasberg mine.
Okay, tell us about Grasberg, because when I think Freeport, I think Arizona copper miner. But Grasberg is in Indonesia, right? Yes, and it is the jewel in the crown. But here is the aha moment. Grasberg isn't just a copper mine, it is also one of the largest gold mines in the world.
You know, I think people forget that metals don't always come out of the ground purely separated.
Precisely. They are often found together in the same ore body. So while FCX is blasting rock to get copper for the AI grid, they are simultaneously digging up massive amounts of gold. And get this, look at the price of gold mentioned in the report. It's trading around $3,539 per ounce.
That is a massive number, $3,500 for an ounce of gold.
It's incredibly high. So think about the economic magic happening here. This analysis argues that you have a growth versus hedge dynamic wrapped into one stock.
So you buy them for the copper. That's your growth play, your bet on the future of tech.
Right. But you also get this massive gold exposure, which is your inflation hedge, your safety net.
It's like buying a tech stock that comes with a built-in insurance policy.
It's actually better than that. The report points out a strategic financial advantage called byproduct credits.
Break that down for us. How does that work on the balance sheet?
Okay, this is critical. Because FCX considers copper their primary product, they treat the gold revenue as a credit against their costs.
I see.
Essentially, the money they make selling the gold pays for the diesel, the labor, and the electricity to run the mine.
Oh, wow. So the gold pays the bills.
In a way, yes. It acts as a massive subsidy. It lowers their effective cost per pound of copper. So even if copper prices were to fluctuate, that high gold price protects their margins.
That's incredible.
It's a double-barrel shotgun of value, as the report puts it. You aren't just betting on one horse, you're betting on two winners running the same race, and one is paying the entry fee for the other.
That is a fascinating way to look at it. You're getting the plumbing for the future and the currency of the past all in one trade. However, and you knew I was going to do this.
Here comes the devil's advocate. I'm ready.
I have to. If I pull up a finance app and look at Freeport-McMoRan right now, I see a price-to-earnings ratio, a PE ratio, of 41x. Now, for a mature mining company, that looks incredibly expensive.
It does.
Tech stocks trade at 40x. Miners usually trade at like 10x or 12x. If I'm a value investor, I see 41x and I run away. Isn't that a red flag?
On the surface, absolutely.
Right.
If you're a strictly algorithmic trader or just glancing at a dashboard, a 41x PE on a miner looks like a sell. But the report explicitly calls this the PE trap. Yes. They argue that this number is fake, or at the very least, highly misleading.
How can a PE ratio be fake? It's just math.
It's math based on past performance. And in this case, the past quarter had a specific non-recurring event. The report details a mud rush incident that occurred recently.
A mud rush? That sounds surprisingly visceral for a financial report.
It's a significant operational hazard in mining. It's exactly what it sounds like, a sudden inflow of wet ore or sludge. Because of this, they had to pause production in a specific sector of the mine to ensure safety.
Okay, so production stops.
Production stops, which means revenue stops for that period, which means earnings tank. When earnings, the denominator in the PE equation tank, your ratio spikes mathematically.
So the denominator got crushed by a temporary event, making the ratio look artificially high.
Exactly. It's a glitch in the matrix caused by a one-time physical event. The report says, don't let the algorithms fool you. You have to look at the forward-looking metrics.
So what are the real numbers if we ignore the mud and assume the mine is running?
The report points to the forward PE, which is based on estimated future earnings. That sits closer to 24x.
Okay.
Still a premium, but much more reasonable. And the price-to-sales ratio is around 3.25.
That is a massive difference, 41x versus 24x.
And here's the lesson the expert emphasizes. Markets price the future, not the past. If you are staring at the trailing PE, you are driving by looking in the rearview mirror.
Right.
The report warns, and this is a quote, if you wait for the PE to drop back to normal levels, the stock will already be at $80. By the time the data looks safe, the opportunity is gone.
That's a classic market dynamic. Uncertainty creates the discount. Once the uncertainty is gone, the price adjusts up.
Right. And remember, they are recovering into a market where copper is at $4.68 and gold is over $3,500. It's the perfect storm for a violent rebound in earnings.
Okay, so we've covered the macro need for copper, the hidden gold bonus, and why the valuation might be deceiving. Now let's talk timing, because even a great company can be a bad investment if you buy it at the wrong time. The report moves into technical analysis for what they call a blue sky breakout.
This is where we look at the chart patterns to see what buyer and seller psychology is telling us. The report identifies a cup and handle formation on the weekly chart.
For those not glued to charts all day, can you walk us through the psychology of the cup and handle?
Sure. Think of it as a visualization of supply and demand battles. First, you have a high, then a sell-off that curves back up. That's the cup.
Okay.
It represents a period where the stock digested bad news. Maybe that mud rush and weak investors sold out. Strong hands accumulated the stock back up to the previous high.
So we're back near the highs.
But we don't break out yet. We drift slightly lower or sideways. That's the handle. This is the final shakeout. It's the stock coiling, building up potential energy, tightening up before the sprint.
And according to the report, where is the price sitting right now as of this analysis?
At the time of the report, FCX is closing at $60.07. The analysis describes the stock as flagging and coiling. It's sitting tight, right under the ceiling.
And there's a specific number mentioned, a line in the sand.
Yes. $60.71. That is the 52-week high.
Wait, we are at $60.07? The trigger is $60.71.
We are talking pennies. Less than a 1% move.
That's incredibly close.
That's why the sentiment is pounding the table. We aren't predicting a turnaround from the bottom. We are sitting on the launch pad. The expert argues that $60.71 is the trigger. If the price can push through that level, there is no overhead resistance.
And that's what they mean by blue sky breakout.
Exactly. Blue sky, meaning there are no historical sellers waiting above that price to dunk their shares. Everyone who owns the stock is in profit. There is no bag holder psychology holding it down. It's pure price discovery mode.
So if you're listening to this and you buy the thesis, you believe in the copper crunch and the gold hedge, how does the report suggest executing this trade? Because buying right at resistance can be risky.
It lays out two scenarios depending on your risk tolerance. The conservative approach is to wait. You don't buy yet. You wait for a daily close above $61.
You want confirmation that the breakout is real, not a fake out.
Right. You miss the first dollar of profit, maybe, but you have much higher certainty that the momentum is real.
And the aggressive approach.
The aggressive play is buying the dip right now at $60.07 before the earnings breakout. You're betting that the macro pressure from copper and gold makes the move inevitable.
You get a better entry price, but you take on a little more risk.
Exactly. The risk that it hits $60.71 and rejects again.
And if we do clear that level, what's the upside?
The report sets a technical trajectory towards $70. From $60 to $70, that's a nearly 17% move on a major industrial blue chip. In this market, that is significant alpha.
So let's pull the lens back and synthesize this whole narrative. Because we covered a lot of ground today.
It's a complex story.
We started with the AI hype. Everyone is looking at the chips, the software, the cloud. But we realized that's just the roof of the house.
Right.
The reality is that the chips need power. The power needs the grid. The grid needs copper.
And we have a structural shortage of copper that will take a decade to fix.
Right. Then we zoomed in on the company that controls that copper, Freeport-McMoRan. And we discovered they aren't just a copper play, they have a massive hidden gold mine inside their business that essentially pays their operating costs.
A double barrel value.
We debunked the idea that they are too expensive by digging into the mud rush anomaly and realizing the PE ratio is lying to us. And finally, we looked at the chart and saw a stock that is coiled like a spring, sitting just 64 cents below a massive breakout point.
It's a very complete thesis. It connects the hard physical constraints of the real world with the speculative excitement of the digital world.
It really makes you rethink what an AI play actually looks like in 2026. We are so used to thinking it's a server rack in a cool room in Silicon Valley, but maybe the real AI play is a big hole in the ground in Indonesia.
And that raises a really important philosophical question for everyone listening to consider. We've spent the last decade, maybe the last 2 decades, valuing software, intellectual property, and code above everything else. Asset-light businesses were kings.
Right. Software eats the world.
But if AI is truly the future, and if it requires this much physical energy and raw material to run, are we approaching a tipping point? Are we entering an era where the energy and the raw materials become more valuable, or at least more critical, than the software running on them?
That is a heavy thought. The code is useless without the copper.
Exactly. You can write code overnight. You can clone an algorithm in a second. You can't build a mine overnight. The scarcity is shifting from the digital back to the physical.
Well, on that note, we're going to leave you to ponder the plumbing of the global economy. It's complex, it's messy, but as this report suggests, it might be where the real opportunity is hiding. Thanks for diving in with us.
Always a pleasure. Keep questioning the consensus.
Don't forget to like, share, and subscribe for more.